Okay, here's our first little foray into chapter 2. Chapter 2 is about analyzing and recording transactions. I can't make a big enough deal of this. This is very important as far as the rest of the learning. What we learn in chapter 2 is really the tool that we use to study accounting for the rest of the quarter, right? So this whole chapter is all kind of big deal stuff, right? But it starts out pretty simple. If you remember in chapter 1, we had our accounting equation, right? Assets equals liabilities plus owner's equity. And then we had accounts within each of those classifications, right? We had cash, which was an asset, and we had accounts receivable, which is an asset, and some of those kind of things, right? So those are kinds of accounts that fit under those classifications. The first way we're going to look at an account, this is a teaching tool that we use, right? And so the first way we're going to examine an account is through the use of this thing. This is what we call a T account, right? A T account is set up like this. It's got the title, right? The title of whatever account that we happen to be dealing with, right? We have the left side and the right side, right? And now this stays consistent, left and right. The other thing that stays consistent is the left side of the account we call the debit side, and the right side we call the credit side. This is one of those deals that throws people for a loop. This video and the next one that we're going to do. Because these words, we think we know what those words mean, but there's more to it than that, right? For what we know right now, all we know is what? Debits are on the left and credits are on the right, okay? So I have this T account, title and debits and credits, and this is where we capture transactions, right? This is where we kind of record information about like things. But the first thing we have to do is we have to understand how this works and how to manipulate it, right? So for instance, like I said, we use these T accounts to capture transactions. So say that we have this T account. Doesn't matter what account it is, right? Just whatever it is, but it's going to capture things that have happened in the business. So let's say that we have on this side, which is what? The debit side, we have $80 and we have $120. Two transactions, right, that landed those two amounts on the debit side of this account. Credit side of this account only has one transaction, and that transaction is for $130, right? So now I have this T account with all these numbers in it, right? Well, if I want to balance this account, I want to know what the balance in this account is, I foot it, which simply means that we add both sides, right? So this total is what? $200, and this total is $130, right? I take the difference, 200 minus 130 means what? $70. Now notice, I wrote that $70 where? On the larger of those two sides, right? Larger of those two sides. So these numbers, right, I just made up the 80 and the 120 and the 130. Doesn't matter what they are. It's just transactions that we've captured, right? But no matter what the transactions are, this is how I get to the balance of an account. So I would say that we had a $200 on the debit side, $130 on the credit side. So this account has a $70 debit balance. Now you notice I wrote DR. That's the abbreviation for debit, even though debit doesn't have an R in it. Don't know why that is. It's just the way it is. Let's do another little example of this T account, right? So this time I have some account, right? With a title, and now I have 100 and 300, and on this side I'm going to have 200 and 450 and another $100, right? So we have those, this T account. These are all transactions that we captured in whatever particular account this is, right? And so if I want to know the balance of this account, first I do what? I foot it, which means I do what? Add both sides, 400, that would be what, 650, 750, right? So I take the difference, 750 minus 400 would be $350. And I'm going to write that on the larger side. So I would say this account has a $350 credit balance, right? That has a $350 credit balance. That's how we work T accounts, right? One other thing I'll say, and we'll have to talk about this more as we do things, there's no formal time component to this, right? But we're capturing transactions that happen throughout the period. So if you think about it, in a T account, the stuff at the top of a T account is going to be earlier in the period, and stuff at the end of the T account is going to be later in the period, and the balance is always what? The balance is always the last number that we have in the column, right? Like this has a $70 debit balance. This has a $350 credit balance, right? So this is just a description of these T accounts. They're going to play an important role in the next video. In the next video, again, it's very important. What you need to know right now is I have a T account. It's got the title, whatever account it is, right? If this were an actual thing we were doing, this would say cash or accounts receivable or accounts payable or John Evanson Capital or whatever the account title was. We have the left debit side and the right credit side, right? So that's your takeaway from what we've done so far. The next one, we're going to take this and incorporate it into our fundamental accounting equation.